In finance, a foreign exchange option is a derivative financial instrument where the owner has the right, but not the obligation, to exchange money denominated in one currency into another currency at a pre-agreed exchange rate on a specified date. The FX foreign exchange market is the deepest, largest, and most liquid market for options in any kind in the world. Most of the FX option volume is traded over the counter and is lightly regulated. However, some is traded on exchanges such as the Philadelphia Stock Exchange or the Chicago Mercantile Exchange. As in the Black-Scholes model for stock options and the Black model for certain interest rate options, the value of a European option on a FX rate is typically calculated by assuming that the rate follows a log-normal process. In 1983, Garman and Kohlhagen extended the Black-Scholes model to cope with the presence of two interest rates, one for each currency. Suppose that RD is the risk-free interest to expiry of domestic currency, and RF is the foreign currency risk-free interest rate, where domestic currency is the currency in which we obtain the value of the option. Here are the formulas. It's D1, D2, the price of the call, the price of the put. So if we go here, we put in the current spot rate of the foreign currency, 0.7. T is calculated automatically. So we put in our duration in days. Our basis is 365 days for a year. K is the strike price at 0.72. If we could find the standard deviation, the volatility is 27.56. The domestic rate is 5.75. The foreign rate is 6.25. And time. Here is D1 from our formulas on the previous tab over here. And here's D2. There's the normal distribution, N of D1, N of D2, and the negative, the inverse. Here's the call price, and here's the put price.